This is LONGWave, featuring technical analysis and market analytics by Gordon T. Long, editor and publisher of GordonTLong.com. The content of this presentation is strictly the opinion of Gordon T. Long and is based on his analysis, which he feels to be accurate and unbiased. Participants may or may not hold positions in any securities that are discussed. You should always consult a registered investment advisor before making any investment decisions. Now, let's join Gordon for today's show.
Good morning. It is Wednesday, September the 9th, 2015. I'm Gord Long at GordonTLong.com. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. The purpose of the audio slides is to talk about the areas that are not updated in your monthly analytics and technical analysis report. This is based on our annual cycle as outlined on the subscriptions page on our site. We intentionally keep the technical analysis charts to the subscriber report so as not to confuse them with the drivers operating behind them. Drivers in the long term are primarily the fundamentals. In the intermediate term, risk, and the short term, confidence and sentiment. This month, I'd like to cover a range of topics listed here. The fact that we have 2 negative quarters of revenue says we have a revenues recession. And actually, I also believe we have an earnings recession, which I'll talk in more detail about. I've talked extensively about the global slowing, but it seems that everybody finally got the memo. And I'd like to examine global trade and global industrial production numbers to show you the severity of the problem. Also, I'd like to talk about the U.S. dollar squeeze, which is a $9 trillion carry trade problem that is complicating matters significantly. And I want to revisit our real deflation, or our M-top, that we have talked about previously, which I believe is now underway. I've been talking for some time about a potential earnings recession, and possibly even something worse on the horizon. Q2 earnings season and conference calls were as we expected. It marked the first time the S&P 500 index has seen 2 consecutive quarters of year-over-year revenue decline since Q2 2009 and Q3 2009. The blended revenue decline, according to FactSet, for Q2 2015 was a negative 3.4%. Earnings per share held up by share buybacks has been signaling this problem for some time now. An economic recession is characterized as 2 consecutive quarters of negative growth. Though the media will avoid saying it, 2 consecutive quarters of negative top-line sales growth by the S&P 500 markets indicate a revenue recession. Such an event always precedes worse to come, and I was unable to find an example where this was in fact not true. Q2 2015 marks the first time the S&P index has seen 2 consecutive quarters of year-over-year revenue declines since Q2 and Q3 2009. As I said earlier, the blended revenue decline for Q2 2015, according to FactSet, was negative 3.4%. Margins shot up to save the earnings this quarter for reasons no one can explain other than historic levels of new car leases. Also, these historic high margins are expected to increase even further. That is a real question mark. Something is obviously wrong here. Maybe this is the correct way to look at what is happening with margins and what we can expect going forward. It doesn't take much analysis to see the sell-side analysts are hoping for a miracle. In a moment, we'll take a tour of the world looking for where this miracle may be found, if it can be found at all. Valuations by any measure are at historical levels, as are corporate profit levels. It is difficult to see how both can be sustained much longer. We have talked extensively about this with many charts in previous sessions, and I will leave you to review previous LONGWave slide sets. Let's walk around this world and see what we see. Ouch. I certainly haven't seen this chart in CNBC. Have you? Why not? Because the sell side are their advertisers, that is CNBC's advertisers. People might get nervous if they saw a chart like this. Let's take out price for a moment and consider just global trade volumes. The analysts report on CNBC it may be down, but that is because of currency issues. They are right to a degree, then leave currencies off the table when they avoid earnings headwinds due to the exchange issues associated with repatriating to a strong U.S. dollar. We'll get to that in just a moment. Consider global industrial production versus trading products. Cheap money after the 2008 financial crisis clearly lifted production and supply. The trend has been down as it approaches contraction, as demand is not there to match this ramped-up supply. It's not difficult. It's just about supply and demand and the impact that cheap money over a protracted period of time has to supply versus demand. Japan's industrial production is already negative, and it's been on quantitative easing and quantitative and qualitative easing for 20 years. With used car inventories a problem and 3-year lease returns about to hit the market, with prices, by the way, already having fallen 7% but not making the press, it doesn't bode well for the Japanese automakers going forward. The Euro area industrial production is barely positive, and the same thinking can be said about all the European auto sales that it is very, very reliant on, specifically Germany. Emerging markets are falling fast, but somewhat better, at least currently, than the others. We'll talk about emerging markets more in a moment. I think this graphic of Latin America really shows the degree of the problem. Brazil is already in a recession, as is, for example, Russia, South Africa, and many others. Falling commodity prices are having a profound impact across all of these Latin American economies so dependent on their export of commodities to the more industrialized developed economies. And as you can see, it's been going on for quite a period of time and getting worse. Everyone says the global engine will be the recovering U.S. economy. This chart and many others I've shown in these presentations suggest this is likely a flawed premise. Even perennial bulls like Goldman Sachs are sending strong signals of concern, as is Deutsche Bank, Morgan Stanley, and many of the other international banks. In the July Global Macro Tipping Point report, I laid out the warnings from the IMF, World Bank, OECD, and Bank of International Settlements. They couldn't be any stronger and warning consistently here for about 14 to 18 months. Concerns are everywhere, and with the U.S. potentially raising rates and further strengthening the U.S. dollar, it has the potential to be like throwing a match on a tinderbox. This chart from the Bank of America, Merrill Lynch, also lays out what may be ahead regarding a possible U.S. manufacturing recession. Evidence point to the fact that it has been a build-out in increased inventories and stocking associated with cheap financing that has artificially held up overall industrial production. Cheap money says you can hold a lot more inventory for a longer period of time. Clearly, we already have a revenue recession, and we are very close to, if not in, an earnings recession. Earnings in Q1 were initially reported at negative 0.4%. Earnings in Q2 were reported at negative 0.7%. It says we are very close to or already in an earnings recession also. The early Q3 earnings show the trend continuing and actually getting even worse in the first 2 months of the third quarter. During the first 2 months of the third quarter, analysts lowered earnings estimates for companies in the S&P 500 for the quarter. The Q3 bottom-up earnings per share estimate, which is an aggregation of the estimates for all companies in the index, dropped by 2.7% to $29.25 from $30.06 during this period. The headlines are very clear. Wall Street is bracing for profit declines. The smart money is liquidating and has been for quite a period of time. The corporate earnings cycle has just turned negative in the U.S. and is very clearly overdue no matter how you look at it. The crisis across the emerging markets in Asia is emblematic of previous crises, maybe, possibly, even worse. It is more than debasement of currencies to gain economic advantage going on here. It is actually capital and hot money leaving, which is pushing down the currencies and by default pushing up the U.S. dollar. We also have, additionally, emerging markets on the wrong side of a $9 trillion U.S. carry trade, which is money that they borrowed to expand their supply and build out because it was cheap, and the cardinal sin of the carry trade is to never borrow in a rising currency, and they thought the U.S. dollar would be a falling currency. We have effectively a global short squeeze on against those who are betting on the U.S. dollar's demise. What is called the Great Emerging Unwind is underway. There is no doubt about it. A triple unwind of emerging market credit, China's massive unregulated and uncontrolled financial leverage, and the threat of U.S. monetary easing by the Federal Reserve. It's like the perfect storm here. The strength of the U.S. dollar has been almost parabolic since the Federal Reserve's taper program actually was announced and enacted. If all this is bad enough, we now have the global manufacturer, China, with a 1929 level market crash and dramatically slowing economy with numerous points of contagion threatening around the world as a direct consequence. I have shown this chart, which I refer to as the M chart, many times over the last year and a half. The current leg down is the real deflationary leg, which I warned of in the globalization trap 2-3 years ago. It is fundamentally about excess supply from cheap money, which results in commodity collapse, loss of pricing power, and the export of deflation to the U.S. in terms of asset value and to some degree products. The U.S. inflation will be primarily in what people need versus want, don't finance, and are domestically centered. All types of home and professional services, healthcare, etc. fall in this range, which are actually increasing by 6 to 8% or more per year. Note, before we leave this chart, that the regression lines here going diagonally through the chart are with standard deviations start in 1971, in August 1971. This is labeled on the far left side of this chart. This chart is the previous schematic chart in actual real time available on triggers. Again, it shows the regression lines going back to 1972 when the US dollar became a fiat currency. The central bankers will step in our opinion, in a massive coordinated way with helicopter money, possibly another form of quantitative easing, and collateral guarantees before or as we approach the long-term red regression. What this chart shows is the boundary conditions established by trading volatility during the 2008 financial crisis. We believe they show a similar limit around 2015 in the S&P 500 index, or lower, as it might spike through this boundary condition because it's starting to band very tightly. Alan Greenspan often testified before Congress, when he was chairman of the Federal Reserve, that sentiment and confidence shifts were the one thing he wished he could predict and control. They, to him, determine economic directional shifts. We are seeing this shift occur globally. And we have seen this beginning to change in the U.S. since Q1 of 2015. It is very cyclical in nature and needs to be carefully watched when it begins to occur because it takes markets with them. It always has. It cannot be understated what the impact of falling oil prices has on the economies of many export economies. They are being forced to issue bonds or sell assets because of falling current accounts. This reduces massive petrodollar profits flows into the global financial system. Therefore, it pulls at liquidity. As we have pointed out in previous matter reports, we believe the anticipated fear will be contained within the rising trend channels shown here, at least through early fall. As I've said, we believe the real deflationary leg is well underway. It has been clear in the commodities market since the beginnings of taper. It has only recently become evident to the U.S. equity markets. When the Fed is forced into quantitative easing 4, or whatever they will call it, helicopter money, which is direct money right bypassing the banks, or collateral guarantees, or I should say, and collateral guarantees in equity and bond markets, we can expect real elevated inflation and the strong possibility of eventually possibly seeing hyperinflation. As I have to keep saying, never forget, hyperinflation is a currency event which explodes prices higher, and therefore through money velocity increasing dramatically. This is because confidence in the currency is lost. It will be about lost confidence in the U.S. dollar, which is now seen to be the paramount of strength, or possibly the replacement of the U.S. dollar as the dominant global currency during some sort of de-dollarization event crisis. Let me reiterate, I continue to fully expect a Minsky melt-up before all this ends very badly, likely through the mid-2016. Never underestimate, however, what bankers and Federal Reserve, central banks, and politicians will do when things get bad to protract or kick the can down the road. Eventually, it will be clear to all that the central bank policies have been a failure. The government's policies of financial repression are becoming too heavy-handed as productivity falls, high-paying jobs continue to disappear, and tapped-out consumer demand steadily erodes. In closing, I'd like to take a moment as a reminder. Do not trade from any of these slides. They are for educational and discussion purposes only. Thank you for listening, and until next month, may 2015 be an outstanding investment year for you. Thank you for listening.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.